Thank you, everyone, for joining us today. My name is Xander Heinen, president of FinLink, and I'm excited to be here to discuss a very new partnership we've entered into with Exchange Place. Exchange Place is an alternative investment platform, bringing some very forward-thinking opportunities to market. We're living through a meaningful shift in capital markets, regulatory modernization following the Jobs Act, rapid digital innovation, and growing investor demand are reshaping how alternative investments are accessed and delivered. Historically, many alternative investments were limited to institutions and ultra high net worth investors. Today, technology and modern structuring are beginning to change that. And that's exactly where platforms like Exchange Place come in. Before we get started, just a quick note that today's discussion is for informal purposes only and should be not considered investment advice. Any investments discussed involve risk and is only available to qualified investors. It's my pleasure to introduce George Hall, the founder of Exchange Place. A little background on George. George brings decades of leadership and strategic vision in the alternative investment space. Prior to founding Exchange Place, he served as CEO of the Clinton Group, a hedge fund specializing in alternative investment strategies for nearly 40 years. Throughout his career, George has focused on identifying differentiated investment opportunities and building disciplined structures that allow investors to participate in them. Under his leadership, Exchange Place is building a dynamic marketplace designed to responsibly expand access to private market opportunities while maintaining a strong emphasis on structure, transparency, and long-term growth. The platform spans several interesting verticals, including sports, which we'll focus on today, and athlete investments, entertainment, media projects, vineyards, and lifestyle assets. Also, George is an expert in structured investment products like your structured note offering. I'll also share a quick anecdote. George and I began this discussion probably a couple of months ago, and I'm a black belt in jiu-jitsu, and I've very, very fondly followed UFC for a number of years. And George will get into that, but he has found a way to bring an investment to mixed martial artists, especially those in the UFC. George, I appreciate you being on today, and I'll let you take it from here.
Great. Well, thank you very much for that introduction. I appreciate everybody's time. I would encourage, if you have questions, maybe throw them in the chat that we can see them. And because I don't want to talk about things that are uninteresting to people. And if I have to shift, I can shift. I have a bunch of bullet points, but I'm probably not even going to look at them. I'm just going to start talking as I usually do. So thanks for your attention. Let me go back into the beginning. As Xander mentioned, Clinton Group, we were one of the first mortgage hedge funds. We actually had, I think, a significant role in the evolution of the mortgage market and how that was, moved into structured products, collateralized mortgages, credit card, all the things that are automobile loans, all the things that are very common today. They didn't exist 30 or 40 years ago, and it's really just the evolution of the market. And the market and the people's attitudes towards investment continues to change. And I'd like to talk a little bit about how I see the evolution. And the evolution is really technology and regulatory issues that have evolved, as well as investor appetites. But the goal here is to show you our platform and why I think we may have opportunities that would be interesting to your investor base. That's really what we're all about, is trying to find investment opportunities that can give people either more return or a better risk-adjusted return. While there's, I don't know, hundreds of billions, if not trillions of dollars fighting for that excess return in the stock market. And frankly, it's not really there anymore, and people have, resorted to indexing. Meanwhile, there's also trillions of dollars of unsecuritized assets and cash flows that actually I think can give people some interesting returns. In addition to finding assets and cash flows that we can securitize and improve people's earnings outlook, we think we can add another dimension that people can invest in things that are actually interested in. So if you can buy a corporate bond but you happen to be a big UFC fan or basketball fan, there are opportunities to invest in assets that hold a lot of personal interest and emotional interest, as well as potentially give people a more return. People that love movies and film and theater may find investment opportunities that not only have the upside of those investments, but also that people find interesting and fun. And I'm going to walk a little bit through how we try to merge content and entertainment with investment opportunities. But keep in mind, every investment that we offer on the platform is something that we have underwritten, that we feel like we understand, and we're bringing it to people because it's a good investment, not just bringing it to people because it's entertaining. That being said, not all of our investments are going to be risk averse or risk free, and some of the investments, your first intuition would be to say that it may be risky. But most venture capital deals that very sophisticated investors invest in wind up going broke, and hopefully a few home runs happen, and that's how people go into the venture world. So even risk of total loss, as long as the upside is far greater than the investment opportunity, that's something that I think people should consider. Let me talk a little bit about the regulatory environment. The Jobs Act was really transformational and a generational change in not how people can invest, but what alternative investment issuers can actually do. In the old days, for years and years, I traveled around the world trying to show people investments, sitting in meetings. And these had to be prearranged meetings through either incoming calls or people that we knew or people that we were introduced to, and you couldn't advertise. And now, actually, under certain constraints, there's a rule, Reg 506C, that allows a certain amount of advertising or at least public presentation of investment opportunities. And again, I'm not giving anybody any legal opinions or anything here, but that's basically the rule that has changed. You'll also see that things like Reg A have evolved. There's a significant amount of capital that can be raised for companies through Reg A. And what that really does is makes investing much more egalitarian and democratized. Now, where I see the biggest opportunity is to take asset classes that people couldn't normally invest in and allow them to invest, even if they're not accredited. And regardless of how big their portfolio is, they can put a very small amount. And if you look at kind of a classic 60-40 individual investor portfolio versus what an endowment or a sovereign wealth fund or a pension fund does, it's quite different. Now, through fractionalization, there's the opportunity for people to invest in lots of different things and diversify their portfolio and hopefully improve their risk-adjusted returns. So if it's all right.
There was another regulation, Reg CF. That was the crowdfunding one. Correct me if I'm wrong.
Yeah, so Reg CF is every regulation, the accredited investor, private placements that you've heard of for years are generally issued under Reg D, which is an exemption from the normal public company registrations. But it has limitations. Investors have to be accredited. You're limited to 2,000 investors, and there's other limitations, and you couldn't advertise. Then they came out and as part of the Jobs Act, they came out with Reg CF. And Reg CF was really designed to give venture capitalists easier access to investors. So they started out with you could raise $1 million from unaccredited investors, and you have to do it through what they call a Reg CF portal. You may have heard of Start Engine or Kickstarter or WeFunder and some of these early stage investment portals. Then they expanded it, so now it's up to 5 million. So if an issuer wants to raise up to $5 million, they can do it through a Reg CF offering, and it doesn't have to be for accredited investors. I think more powerful and more important is Reg A, which allows issuers to raise up to $75 million. And I describe it, again, in a non-legal way, but it's kind of a cross between a private placement and a full-blown public offering. There is a prospectus. The SEC comments on it. The SEC doesn't opine on the value of the investment, but they do go through a comment period, so the disclosures are at least appropriate in the SEC's eyes. So I think Reg A is going to be the most powerful change in the regulations, and hopefully they'll expand it from 75 to even higher number. So issuers can issue a Reg A offering. Those stocks don't, it doesn't have to be for accredited investors. It could be virtually any investor, just limited by 10% of your annual income, among other small tests. But basically, anybody can now have an opportunity to invest in these things. And they're tradable immediately. Private placements you have to hold for a year. These are tradable almost immediately through what they call alternative trading systems, or ATSs. So the regulatory environment has really improved. And, it makes sense. A lot of what the regulators have to do, they limit it to high net worth individuals, and they create restrictions that try to protect investors that are not necessarily as large or as wealthy or as sophisticated as other investors. But they ultimately, now the regulations are moving towards opening the door to more investors to participate. So with that being said, I'll probably, if it's okay, I'll share my screen and I'll show you our platform, just to talk a little bit about the types of assets and where we think there's real opportunity.
Be great.
So, okay, hopefully I'm sharing. Can you see my screen, Xander?
Yep, sure can.
Okay.
You might want to maximize it if possible.
Okay. Is that better?
Yeah, great.
Okay. So this is an online investment platform. And I'll walk through some of the features of it, but basically people can sign in, and then we can, depending on how far they want to go when they first look at it, there's a bunch of questions that meet the know your customer rules. If somebody wants to become accredited, we can do accreditation right online. But basically, most importantly, here we can provide a lot of information about different asset classes. And here we have kind of the first nine or so opportunities that we're going to really focus on. And Xander mentioned sports, and I can talk more about sports at this point. Um, but I'll also go back and talk to you about how this is evolving in using other companies that I'm sure you're familiar with, like iCapital, and you may have heard of Masterworks and Yield Street. And really, in a lot of ways, it's similar. I don't necessarily view them as competitors, nor do they view me as a competitor. The reality is this is all new, and this private market, these new alternative opportunities, is really just evolving, and there's an enormous number of opportunities for everybody. But what I want to do, given my background, is I want to be, I won't call it all things to all people, but more things to more people. This is a securitization business. This is finding assets that are underpriced or have not yet been securitized, using the experience and the techniques we have to structure investment opportunities for investors. And that doesn't, in some sense, doesn't matter if it's a sports team, or if it's a painting, or if it's a real estate deal. The securitization is really what we're trying to bring to the world. So that's why we have a number of asset classes that we're interested in. But for this moment, we'll talk about sports. This is a live platform. You can go on it. What I'll use here is a demonstration platform. It has a little more material in it. But I'll start. If someone comes on the platform, they can just click Sports Place, which is where we put our sports opportunities. And we have different types of sports, not only professional sports, we have individual sports. You can see motorsports. And if there's a unique following, we tend to isolate it, like combat sports has kind of a unique following that may be somewhat different than baseball or basketball. We also want to bring to the market teams, as well as opportunities in thoroughbred racehorses and even hedge funds that are in sports. So let me start with athletes. And if you go back to, if you think about anything in fixed income, whether it's a treasury bond or a corporate bond or an asset-backed security, you're really taking a stream of future cash flows, coming up with a present value, and that's what something is worth today, depending on what the interest rate is. There's no reason that you can't do that with virtually any cash flow. Some cash flows are certain, some are uncertain, some have more or less credit risk, but you can take virtually any future cash flow and create an investment opportunity out of it. So one among many things we're doing, but one of the things that we find really interesting is the securitization of an athlete's contract, either the contract or just his general earnings from all his sources of earnings power. And we actually did our first deal with an athlete named PJ Washington back in 2019. He was drafted. I don't want to get too much into basketball for people that don't care about basketball, but basically, we came up with a structure where we could create an investment security that was linked to his earnings and his earnings from playing basketball, from merchandising, and so forth. And this is probably not the forum to go too much detail into the structure, but it was structured in a way that had very little downside to investors because of the way we structured it. It was actually such a well-structured investment that it can compete with, high grade bonds. And there were a number of banks that offered us significant amounts of financing or repo. The most important thing is because very few athletes actually have the opportunity to securitize their earnings. We can actually effectively buy these earnings at a price that's lower than you can buy a corporate bond or an ABS security, or at least a yield that's higher than those alternative investments. And cash flow is cash flow. We can analyze the earnings of the athlete. We can put in different financial techniques to, make sure their return is what people are expecting. And and then people can actually invest in things that they find interesting. So PJ, for example, he went to University of Kentucky, so people in Kentucky have a connection to him. He played at Charlotte, was drafted by Charlotte. People in North Carolina may find a certain affinity for PJ Washington. But basically, we create a content site for the athlete, and people can look at merchandise, they can connect to his social media, and there's a lot of information about the player himself. It's a really nice highlight reel. And then there's a lot of news about the athlete and how he's playing and so forth. And this is all content, but this is content driven towards giving people information about their investment, about whether they want to make an initial investment or whether or not they want to trade. And let's face it, the earnings of an athlete, if it's securitized properly, is not a lot different than an asset-backed security that may have some variability for interest rates. This will have variability for different other variables. But we provide a lot of content and news. So in some sense, at least with respect to a particular athlete, people's desire to watch ESPN or read the sports pages can somewhat be disintermediated by a lot of the content that we provide. So let me go back to just a couple of other little asset class or a couple of other asset classes, and then I can come back to sports. Entertainment, there's always opportunities to finance film, and you can do it with debt. You can do it in a securitized way. I know people's first reaction would be that it's risky to invest in movies, and many people have heard horror stories. But if you do it with the right professionals and with the right due diligence and so forth, we think that there are opportunities to invest in entertainment and potentially get pretty good returns. We've got some experience investing in theater. I don't know if anybody has seen any of these plays, but we did make investments in a couple of plays, and we found them to be successful. And in terms of film, we're working on a number of films right now. one of which is a movie about Richard Petty's life, which is a fascinating story. And you can kind of see the crossover between sports and entertainment. If you like NASCAR and if you're interested in some of our NASCAR offerings, you might also be interested in this film offering. So this is actually a video that Richard Petty created for us to talk about the movie. Um, and all of these little spots for videos kind of replace the meetings that you have in your office across the desk from somebody. It's just now, thanks to the Jobs Act and some of the regulatory changes, we can put these on a platform and people can see them. So there's some really interesting stuff, and it's really worth going through this platform at some point, just for the content of it and seeing what we're offering. Um, and then we also want to do the same kind of things that Fundrise is doing in Case and iCapital. So, we've got spots where we can list alternative investments, whether it's a hedge fund or a private equity fund. And then we've got opportunities in different types of real estate that are not accessible and we think will be better than a typical REIT that somebody can invest in. So this is kind of an overview of the asset classes that we're interested in. And we also have created a number of funds, which funds that people can invest in. Now, these are all for accredited investors, but basically, this is a fund that allows us to buy real estate. And then the goal of this fund is to fractionalize the real estate and redistribute it in smaller amounts to more people. So there'll be effectively, some kind of markup in between. So it can be a profitable fund, but these are funds where people can invest in a pool of these assets that we can turn around and redistribute. I know that there's a lot of information out there and a lot of deals done under what are called structured notes. A lot of people love them, a lot of people hate them. I'm somewhere in the middle. I think the theory's great. I think they can be done in a better, cheaper, more efficient way. But we've created a number of our own structured notes. And instead of using bank credit, we basically buy treasury bonds in our structured notes. So if anybody's interested in structured notes, we give a little talk about it, kind of like I said, the meeting across the desk, except you can look at it online. You can go back, and I don't know how many meetings I've had where somebody calls me next week and asks questions about the exact same things that I talked about. So here you can watch it a couple of times if you want. And of course, then you can still call if there's more questions. But let me just demonstrate the investment opportunity or the process to show you how easy it is, which is really one of the things we want to do is make it really easy for people. But I apologize, before I do that, I'd like to show one other aspect of our platform. We have a section for wealth advisors. Now, this is to help wealth advisors get more exposure to investors. So the way we market this platform is through things like Google search and YouTube, Instagram, earned media will, be on CNBC at some point or some similar types of news outlets. And we will bring people to the site, and there will be a lot of people. It's not that hard to get people to come to the site. And we've created an opportunity for anybody that may be looking for a wealth advisor that they can actually do the same thing that we do with our securities. They can talk about their business, where they feel they're strong, and we can list as many wealth advisors as we want to. Of course, we'll want to learn a little bit about your business, and this is a made-up advisor, although there probably is a Pacific Coast somewhere, but it's not the one we're talking about. And then we can create all kinds of connectivity to social media, and people can talk about their wealth advisory business. And the reason is this is kind of a two-way flow of information. This site that I've just demonstrated, it's an opportunity for issuers of securities to explain the opportunity to invest, and also for people that are looking for investment advice or professionals, they can potentially find some interesting advisors here. So anybody that might want to show their company and talk about their company online. We're happy to list them on the platform. So I'll go back to the structured note just as an example of. Sorry, let me go back to. I want to go back to. It's a lot of material here. So, and this Zoom keeps getting in my way. But let me go back. So I'll just show you I'll use this just as an example. Uh, I said we have a number of funds. We have structured notes. We've kind of coined the term zero plus. The goal is to have your principal guaranteed. So your worst case, again, there are caveats. Anything can happen, but um, effectively, we target your worst case is at least you get your principal back over a certain period of time, and then you may have hopefully significant upside. So we talk about the opportunity. There'll be videos here where we talk about it and how we get to the returns that we're trying to get to and how we protect principal. And then if somebody wants to invest, they can just click that button. And now it looks a little more like an investment platform. This will have an overview of the offering, kind of a summary of the offering here. There'll be term sheets and offering documents, financial information, any legal information or disclaimers. And if I go to look at the offering document, if you click that button, the private placement memorandum pops up. And this is as well lawyered as, most private placement memorandums. We use major law firms to create these documents for us. So all the information that used to travel by mail and used to be through, face-to-face discussions can now be provided through this platform. So once you've looked at that and you wanted to make an investment, there will be a button that will pop up, and uh, you can click on it and actually make the investment. So let me just stop there for a minute, Xander. See if you have any questions before we go any further.
Yeah, I'd like to offer it to the community, but I do have a question here. So clearly it's different than conventional product that you're selling, and I think you're right. You're really in the frontier of what this is. What's going on in the fractional world. I think it's really going to open up a huge amount of assets. But when investors think about incorporating alts into their portfolio, how should they think about diversification and long-term positioning?
Well, you should be diversified, and that's the important part of fractionalization. Depending on the size of your portfolio, if everybody would love to get into some huge hedge funds, but you have to have $1 million minimum. But if your whole portfolio is only a million, then you can't do it. The beauty of fractionalization is you can buy things in $1,000 or $5,000 increments and fit it to the size of your portfolio. So you should be diversified. Fractionalization allows you to be more diversified, and then really understand the the risk. And part of the reason I'm focusing on this structured note is this is a combination of, might call it a venture capital deal plus zero coupon treasury bonds. And when you put the two together, the zero coupon treasuries pretty much protect your principal, but the venture deal gives you enough upside that the blended return can be pretty significant. And that's how some of these deals that we talk about that might seem risky, like investing in a UFC fighter's earnings, we can actually offset downside with treasuries and so forth. So, and I'm going to come back to that particular deal and talk about it a little bit more. But basically, you can be as diversified as you want because the dollar amount is relatively small. So if I wanted to invest, I could just put, how many shares I wanted to buy, and then I could just decide how I want to pay for it. And there's multiple ways that you can do that. And then you can place the order and confirm the information, and then the order is going to come. And if you want to see your portfolio, this is, probably not as much detail as you might get, on some other brokerage statements, but it has all the information you need. At some point, we'll create pie charts and some of the cosmetic things that look good. But basically, this is a portfolio of different investments. You can buy more, you can view your portfolio. There's lots of material here. Um, so this really is very much like a brokerage account um, that allows people to very easily invest in different things. I'll do, if I may, one more opportunity. Let me go back. Sorry, the reason I'm fumbling is because the Zoom headings keep getting in my way, and I have to get back to where I was. Um, okay, so you'll see if you come to the marketing page, which is just exchangeplace.io, we have what we call an advisor portal where um, you can, if you are an advisor, and when you do your know your customer, you tell us you're an advisor, we create this portal and this dashboard. And basically, you can create an account for any investor that you want, any investor that you manage money for, and you can see all of our offerings, and you can actually invest this way. So here's a list of accounts. These are actually me and two people, two of my partners. But basically, you can have all of your or any number of your clients listed here. And then if you want to make an investment, you can click it and go through the same process and make an investment. But what this does is it actually allows you to allocate it across all the clients in whatever percentage you want. So say how many shares you want and choose which clients you want to be invested. So we're trying to make this also really easy for wealth advisors um, to have their clients participate in this. And then you'll get, statements from the administrator, and you'll be able to come online anytime and see any client's portfolio and so forth. So, and of course, we're happy to take on any advice that any advisors have on how we might be able to make it even more functional. But so let's go to UFC real quick, unless you have any other questions, Xander, but I'll talk about a specific transaction that we're working on.
Yeah, I just wanted to add, I know it's going to probably come up, there are compliance issues with CRMs and technology. How are you guys positioned for that? And are you able to integrate with other platforms like a wealth box or something like that?
Yeah, so in terms of the regulatory environment, the this is, what we'll call marketing material. And when you get to the investment platform, you'll see the offering documents. That's really where the the rubber meets the road in terms of disclosures. So if it's a prospectus for a Reg A deal, or if it's a private placement memorandum for a private placement, for a Reg D deal. All that information is there. It's all done with all the disclosures that lawyers require, and people download that, or they can read it online. And once they've read it, they can make an investment if they want. So all of that regulatory information is there. In terms of Reg A deals, which you don't have to be accredited for, we actually will sell those deals through a number of Reg A specialist Reg A brokers that provide all the FINRA compliance and so forth. And over time, we'll get our own FINRA license, and we're building our own ATS. But in the short run, there are other ATSs that we'll use for secondary trading. But we spend a lot of time on compliance from when we started to develop this platform. It was done step by step with a number of law firms. So we're pretty confident that uh, the documents that we provide and the disclosures we provide are pretty reasonable. Um, so
Excellent.
I should also scroll down. This is just another video that we have to talk about the platform. You can see we also have series of blogs that we're creating that some of them, people may find interesting, different topics on investors, and if you just click it, this is a blog that we've written. I will say we do have ChatGPT help us with spelling and so forth, but it's all pretty much our ideas talking about markets and alternatives and so forth. So now let's talk from Xander, unless there's a question, I'll talk a little bit about UFC, but you can also extend this to basketball and golf and so forth. Um, we have relationships with a number of UFC fighters, and they have very variable cash flows. And for people that don't care about UFC, you can think of the same thing with golf or tennis. When they play, particularly in golf, for example, if they do well, they get a certain amount of earnings, and if they lose, they get nothing. So you could look at a golfer's career for 10 years and effectively invest in that. And then every time he wins, it's like getting a dividend. And if he doesn't win, then you don't get a dividend. So, of course, if you invest in that and then he turns out to, really fall off the map and be a terrible golfer, we can protect against downside with combinations of treasuries and other ways that we can protect the downside. But basically, this is an opportunity to create an investment, a cash flow based investment on an asset that you might actually have some affinity for. So if we have two UFC fighters, we will price their potential earnings and we'll structure the deal that we think gets the best return, the fair return for each fighter. But Xander may like one fighter and somebody else may like a different fighter. So we're providing choice not only on where the best returns are, but any kind of, personal interest that somebody has. In terms of an NBA player, there it's a very defined contract and series of rules in the collective bargaining agreement that allow us to price the future earnings of an NBA player. And why would we do that? Well, we would do that because there's a lot of advantage to the player to get money up front. And he is willing to sell cash flows at a high yield to investors, at a good risk-adjusted return to investors, because there's value to the athlete having the money today. Just like when you buy a home, you're basically taking a loan to purchase a home based on the expectation that you'll earn enough money to pay the mortgage. So what are the reasons we would do this? Why an athlete might do it? Athletes come out of school, they make a lot of money by Main Street standards, but they're not wealthy yet, even if they're a number one draft pick. And, they don't necessarily get the best, have the best access to opportunities. And if we can give them the present value of some of their expected earnings, it allows them to invest in a more efficient way. They can take advantage of different opportunities, and we actually can help them with that. We've been involved in deals with influencers and help them get, what I'll call special deals or additional opportunities because they're either an influencer or they're a well-known celebrity. So we have some experience on how to help athletes, for example, or entertainers get access to things they wouldn't normally have access to. So that's why it's good for the athlete to do it. But what it also does, since very few people are investing in this, it creates an opportunity to earn a higher yield with better credit risk than you might in a corporate bond. So UFC fighters, they don't have collective bargaining agreements. They just have certain purses that they can make, but we can anticipate, we can evaluate what they might be based on wins and losses. And then with the right combination of some securitization and some collateralization, we can create a really worthwhile investment opportunity for a UFC fighter, a golfer, a tennis player that you might like. Still outperform your typical bond markets because the market's relatively inefficient, but also provide a good opportunity for players that you might like or athletes that you might like.
I have to imagine that can help a lot of the UFC fighters too, especially when they're kind of coming up through the ranks because they're not making a ton of money until they get, a little more acclaim. But if they're making a big splash and they get offered something up front, that's probably a big help to them in their training camps.
Yeah, and I think you look at it, we try to avoid any kind of disastrous investments. We're not saying everything's going to be risk-free or guaranteed by treasuries or protected by treasuries, but in an athlete in a sport like UFC, they have a pretty uncertain future. But if they hit, then they can have an enormous amount of upside. So we create upside for investors, we protect the downside for investors, and it could be, a good opportunity for both sides, and that's what we're really looking for, connecting issuers and investors with interesting opportunities. But again, it's not just all about celebrities and sports and entertainment. We're going to have hedge funds available, venture capital deals that we're in touch with. And, after 30 years of doing this, we've got relationships and due diligence capabilities. So we think we can provide, other types of fund investments that maybe are not on iCapital's platform or not on the Case platform. Um, and
What
you know,
about what about the wine and the vintners? I know that was a topic that you and I discussed. I'd love to hear a little bit more about that.
Yeah, so wine, bourbon, scotch, all types of spirits are now trying to raise capital, not only for the company that manufactures them, and we've all read stories about, particularly when there's a celebrity attached to it, how some of these brands of spirits have taken off and become very valuable companies. That will be something that, and we're in touch with a few young companies that we think have some future, and we will put those under alternatives under our venture capital button. And then, so for example, if I go to alternatives and under venture capital, we may have a list of deals here that people can invest in. And one of those might be a spirits company, and if people believe in the manufacturer of the spirit or of any celebrity that's attached, they can invest. But there's also now opportunities to invest in the spirits themselves. Wine gets manufactured, and hopefully over time it ages well and will be very valuable in a number of years. So this is connecting capital today to fund the fact that it'll be sold at a much higher price when it's drinkable, as they say. So it's really matching, taking investable cash and putting in a place where cash is needed and it can generate a high return. And really separating the person that wants to consume the spirit versus his willingness to buy the spirit at manufacturing and then hold it for 5 years or 10 years. So basically connecting capital with consumers. Um, and I'll stop whenever you want me to stop or answer any questions. But one other thing I think is really interesting that we're writing some blog articles about, and a film is a good example, a restaurant is a good example. Um, People invest in a restaurant and they hope that it works and they hope people come. Um, Now, we think it's a really interesting concept that we can fractionalize, and I'm just using a restaurant as an example of a consumer product. We can fractionalize the ownership so that there are lots and lots of investors, thousands of investors potentially. And if you have thousands of investors that have invested in a restaurant, you're actually enhancing the restaurant's ability to succeed because you then have 1,000 brand ambassadors. If you think about social media, people like to talk about what they're doing each day. And it's really going to, I think, change the advertising model a little bit, where it's not just about purchasing ads, it's about getting brand ambassadors, and who's a better brand ambassador than an investor. So we're working with a number of restaurant chains, companies and chains, and to basically say, look, why have 10 investors when you can have 10,000 investors? It's more likely they're going to come and, consume your product and tell their friends about it. People love the connection to ownership and feeling a part of something. And same thing is for a film. If we have, so one of the things that we have here on our platform is content. And for example, this is a movie that we're in discussions with a writer who wrote a movie. You'll notice this is one of the characters from The Wire. Anybody that liked the show The Wire would probably find this movie interesting. We have a clip here of the star. And if somebody says, I like The Wire or I like other movies in the genre, they can consume a lot of information and make an investment. And now you see the minimum investment's $1,000. If we have 1,000 or 5,000 people invest $1,000, then you have pretty good chance the movie will be successful because that's a lot of brand ambassadorship and people that are going to come and see the movie. So that was kind of a long-winded way of saying I think there's a real opportunity to connect consumers of a product to the actual investment opportunity of the product, and that's an area that I think is early stage and not really fully thought out yet, but it's really important to us.
Yeah, that's interesting. You brought that up with sports too, right? It's like, how do you value? I think I heard a interview with you where it's like, how do you value Taylor Swift's record catalog compared to the Kansas City Chiefs, cash flows? It's really the value lies with the person who likes Taylor Swift or the Kansas City Chiefs, right? It's different. There's a delta
Yeah,
there.
exactly. So the way I try to describe it, I say you could take we used to have a big statistical arbitrage group of quants, and they can come up with the fair price of Taylor Swift's earnings or of the Kansas City Chief, and then come up with the theoretical fair price. But if you like football and you live in the Midwest, the Chiefs may be more interesting than Taylor Swift, or vice versa. If you like music and you like Taylor Swift, that might be more interesting. So there's that incremental value that people get from the investment. But think about teams. Now, if an NFL team is going to list, I actually won't show some of these teams because we're not there yet. But we basically have had discussions with USHL hockey teams about listing and so forth. And the question, but I'll take it down because this is not an official offering. But the real question is, and the real thing to think about is ownership and how that makes people feel about something. So I'll ask anybody that's a sports fan, if you like watching the New York Rangers, but you own a piece of a USHL team, which people that like hockey know that that's the top amateur league in the country, kids heading to the pros. Um, you're going to watch the USHL game because ownership gives you more interest in something than just being a fan. So we're connecting fandom with ownership. And I think that's true. That will be really valuable for some of the leagues that haven't evolved yet, whether that's, US rugby or pickleball. As people probably aware, there's a pickleball league that's emerging, and, giving people opportunities to invest in these things. And again, all these investments have to pass muster on what's the potential return, what's the risk, is it a good investment? But then if you have the right investors and enough investors, you're actually enhancing the probability of success. Because the more owners you have, the more fans and brand ambassadors you have, and that generally will lead to success. So we're thinking, we like to think that we're forward thinking on some of these concepts, and we write blogs about them, and we always welcome people. But if you to either submit a blog that they want us to post or to comment on our blogs, but the world is changing, and the next generation of investors is going to be different than the current. And if you just go on Reddit for any length of time, um, you can just hear people's dissatisfaction with investment opportunities and disclosure, and the gap between what a pension fund can invest in versus what an individual can invest in. And I think that that sharing of information through chats and social media is really what's gonna make uh, this opportunity. And I don't mean just for Exchange Place. I mean for these private platforms that are embracing this. I think this is a pretty special change in the market.
I want to open it up to questions again. Feel free to drop a question in the question and answer box on the bottom here. But I did have one more little question, I guess, that popped up. There are a couple franchises that have IPO'd on the public stock market, and I think that what you just said is kind of a great segue here because people are not happy with the way hedge funds are, and disclosures work, but also just the general stock market. I know we're talking kind of apples and oranges here, but Mario Gabelli, he clued me into the Atlanta Braves stock, which that was my first like real entrance into being able to invest in sports. And I don't like the Atlanta Braves. I bought some because Mario Gabelli told me, but what's the again, apples and oranges. One for accredited investors, one's not. Obviously, there's differences there. But what would be the pros and cons of either or both?
Well, it depends on pricing. I've looked at sports teams going back 30 years and watched the valuations go up and up and up. And I know investment bankers that work on these deals, and they've always said this is the greater fool theory. You don't you lose money until you sell it at a big profit, and that's how you make money. I don't know if that's true. I'm just quoting somebody. And valuations have gone up and up and up, and it would have been a great investment. What's really interesting is the Green Bay Packers, which they're grandfathered in the NFL without going into detail that I don't totally understand. But basically, they are publicly owned by investors, and investors get a certificate, and they don't get any dividends, and they can't sell the certificate. So basically, they don't get anything in terms of financial return. They can pass it on to their kids. So people are willing to invest in the Green Bay Packers with no financial return just because they like feeling like they're part of the Green Bay Packers, which they in fact are, but they're not getting a financial return. Our view is um, everything we bring, we want it to have the right financial return. So I don't know enough about the Atlanta Braves. I mean, I would have thought that these teams are overpriced 5 years ago, but media markets change, and the people's desire for sports just increases. And baseball has a lot of spectacular characters now that people find fascinating, like the Japanese invasion of phenomenal baseball players coming out of Japan. So continues to evolve, and I don't really have an opinion one way or the other on how much a baseball team will improve from here. And a professional, a Major League Baseball team isn't going to need me to securitize them and sell them. They have the New York Stock Exchange and NASDAQ. But other teams um, could be women's teams, a women's hockey team, or an amateur team, something that can really create fandom. It just hasn't developed yet. Pickleball, pickleball has a lot of names, celebrities that own teams, or at least have invested in pickleball teams. So where we want to focus is where we see opportunities to find, what we'll call the NBA of the 50s, or the ABA of the 70s, and find it before it explodes. So whether that's rugby or soccer or cricket, I find fascinating. Those opportunities to invest in teams is where we want to focus.
Yeah, that's interesting. Well, one more question as we wrap up here. Um, It's a really good one. Looking ahead over the next 5 to 10 years, where do you see the alternative investment landscape evolving?
So one thing that's clearly happening, which I find a little troubling, is, it's the old theory of if you buy the IBM computer, you can't get fired. So that's why you don't buy, one of these new computers. Um, in the world of alternatives, you see that funds are just getting bigger and bigger and bigger. And I'm not sure it's because of returns. I'm sure it's because of whether it's consultants or chief investment officers, they all kind of follow this herd mentality. So I think it's becoming overly concentrated. And I think there's, one thing to consider is that things may be slipping through the cracks. So I think that's going to continue. I think big funds will continue to get bigger. I don't think that necessarily means they'll be more successful, but I'm not saying they won't. I don't have a view on that. But I do think there will be enough individuals over time, over the next 5 years, and wealth advisors that are going to say, look, um, by the time I got into one of these well-known funds, the fees that I would be charged would be, make it not as interesting. And I think there's other smaller funds. And now, because the funds can put information out there and make it easier to access the information, I think a handful of advisors and a larger handful of investors are going to go direct. And I think the world is going to open up for issuers and cash flows and assets to find new investors. So I think there'll be a little more of the same. The big get big, but I also think there's a huge opportunity for issuers of smaller funds, smaller alternatives, smaller venture deals to find capital to put to work.
It's truly become a more democratized system than it has ever before. So it's pretty amazing. Well, with that, George, I wanted to thank you for being on today. It's really actually a great conversation to have with you. And again, you're the first product partner we have. Love everything you provided us and the support you provide us. Love your product suite. And I really hope that we can do this again soon. And hopefully we'll have the Detroit Lions on there one day. Not a great investment, but I'll bet with my heart.
Well, I just took my daughter to Michigan, so if she goes to Michigan, I'm gonna be a Lions fan as well. So,
All right, I'm go blue. All right, well, thanks, George. I really appreciate it, and I'm going to be sending out a follow-up email. It will have a link to the YouTube link where you can view this webinar. There was a small hiccup with the timing in our marketing material as opposed to what it was in real life. So apologies for that, but we'll get that out to you right away. George, have a great day, and we'll talk soon.
thank you, everyone.
Bye-bye.